Hey guys, good morning. Good morning, everybody. Good morning. Good morning. How you guys doing today? How you guys doing? Hello, Haruna. Thank you for joining. Good morning. So, I said last time that we have to talk about something that's, I've been having a lot of questions about structure, business structure. How do I structure my business to optimize taxes? How do I structure my business? How do I do this? And I thought this was something that we needed to talk about. So, hi guys. I'm going to take 2 minutes to wait for the other people. Hey, hello, come on. Keep joining and sharing, please. Share it so that we can have more people on the platform. That's the way we're going to increase our viewership, and we're going to reach out to our community. Please do that. Please share. Thank you for sharing. Keep sharing. We have 2 more minutes before we get started. Just keep sharing, guys. Just keep sharing. Share the videos. Share it. Keep sharing, guys. Thank you so much for sharing. Thank you guys for sharing, and thank you for reaching out. Share these videos to as widely as possible, because I think we're taking our time to do something that's most important for our community. So our community needs to know what we're doing, and they need to take advantage of these free videos. People have to pay for this, so we're just giving them out there to educate the public on things that really matter in the community in which we live. So please share as widely as you can, so that we can talk about this topic. Today, again, we're talking about what's the best business structure for my company. And like I said, this is what is this best tax structure for my company. So again, I think this is one of the most important things. So share. We got 1 minute and we get started. 1 minute, guys. 1 minute and we get started. I hail you guys. I hail all of you. I thank you. Respect to you guys. Thank you for taking the time to come and learn something new. Thank you. So, I think we have 30 seconds to go, and then I need to respect your time. Thank you all for coming. Thank you. I need to respect your time, guys. Keep sharing, keep joining and sharing. I thank you for joining. I see a lot of people joining. Keep joining and sharing, and I see the impact of the shares, because I can see the number going up. So today, let's get started. I just want to salute you guys. I want to thank the Lord for giving us the strength to be here and to talk about these things that He has inspired us with. So today our topic is, what's the best tax structure for our business? This is a very, very important topic, because for those who've been following me and who know a little bit about this stuff, they will understand that I say all the time that structure is everything. Structure will make your business, or it will destroy your business. The way you structure your business means everything for the business. And that's why I really thought this was something we'll talk about today. So today, there are 2 things when it comes to structure. When people talk about structure, there are 2 things that come to mind. The first one is the legal form of a company. What is the legal form of my company? And then the second thing that comes to mind is what is the internal structure of my company? How do I structure my company internally, from CEO right down to each person working within the company? That's internal structure of the company. But today we're going to focus on the legal form of the company and how it impacts you from a strategic intent perspective, from a tax perspective, and from many other perspectives that you have set for yourself as you start your business. So the legal form of a company is what influences your day-to-day operation as a business, okay? So let's look at this. So the key things I'm going to talk about. So I'm going to be, I'm also looking at the Zoom, the people who are on Zoom, so you'll see me time to time going from left to right. I'm still concentrating on you guys. So why is structure important? So everybody who starts a business, there's something called a strategic intent. It's also dependent on the industry, what industry you are in, what is your strategic intent of your business. And then you're thinking about legal protections. You're thinking about protecting yourself from the business, protecting your person from the business. That's something you want to think about. So another thing is the tax treatment. The tax is the single most expensive bill for everyone living in America. If you look at your bills, tax is the most important bill. So that is why when you structure your taxes accordingly to pay your fair share, then what happens? You are building wealth for yourself. Because the IRS, the government, doesn't want you to just spend money out there. They want you to do those things that they want you to. So structure becomes key. Let's look about, so we also structure because government requirements, there are so many government requirements. We want to structure to be able to optimize on those requirements as well. So, getting into the meat of the thing, what are structures? So there are two main types of structures in a company from my perspective. There are some structures that are called informal structures, and there are others that are called formal structures. An informal structure means you don't really get to do a lot to get going. For example, when we talk of a sole proprietorship, what is a sole proprietorship? A sole proprietorship is just an individual getting into business. In the United States, you don't need a license to operate as a sole proprietor. So you just get started. It's an easy to form process. And then there are no legal requirements really of a sole proprietor. I mean, when people come to me and say, Charles, how do I structure my business? One of the first things I always tell them is, come on, go make the money. If you're a sole proprietor, go start making money. We'll see from there how we structure your business. Because there's no requirement for you to do anything before you get started with all the structure. Another thing is, when you think about structure, sole proprietors are people like contractors, freelancers, service professionals. They get started with their business, and that's it. So they may need what they call a DBA, which is a doing business as. It's basically if you had a name for that company, you want to preserve that name for that company because someone else might use it. So you register a DBA just to preserve the name of the company. And then, the other thing is, when you have a sole proprietorship, it defaults to what we call a Schedule C. So you're filing taxes on your own personal taxes. There's just a portion, there's a section of the tax return, of your personal tax return, on which you report your incomes and expenses related to that business. That is called a Schedule C. You don't need an EIN number, you don't need nothing. You just need to show the income and expenses. But you also need to show that it's a legitimate business that you're doing. So, and then one advantage of this is that you get the same tax deductions as you would with other structures because it's a business. You just created a business. The main limitations is that you don't get limitation of liability with a sole proprietorship. Limitation of liability simply means that if you are owing third parties, okay? So if the business is owing any of its suppliers or any third party, or if somebody had an accident in your business and something happened to the business, happened to that person, and that person were to sue the business, he is basically suing you because there's no differentiation between yourself and that business. So there is no limitation of liability between yourself and the business. So that is one of the main limitations of a sole proprietorship. Another thing, in case of default, your personal assets will be exposed, just like I said before. So basically, the guy who is suing your company will come after your personal asset, they'll come after your car, they'll come after everything. They can actually sue you and collect all those things. So there is no limitation of liability. There is no one other thing is that one of the main issue with sole proprietorship is that you don't have business credit. Business credit is very important. One of the things I've been talking about a lot is about access to credit. We are here. We are in this country and we have access to credit. Anywhere in the world you need access to credit. But as a business, when you set up a sole proprietorship, you cannot create, that company does not have its own credit. So you use your personal credit to do that, to access any loans or any whatever is out there in terms of capitalization of the company. And what does that mean? That means that access to capital becomes a little bit more difficult because you have to use friends and family and savings to be able to run your business. Then you have very little, you have a few tax shields, but not as many. One of the big advantages with this sole proprietorship is that you don't get to do a lot. I mean, there's less administrative things to do. Then, the second one, and I mean, if you have any questions out there, I'll be glad to answer them. But I've received a couple of questions. We'll answer them at the end. I'll just go through this, and then we'll go through your questions, and then we'll go through, and then we'll answer all of them. Okay? So, the second part is a partnership, a general partnership. A general partnership is really just, it has the same functionalities as a sole proprietorship. It's okay, you need to run a business, you want to start a business, you call your brother, you get started. Any business that you start with 1 or 2 members as owners of the business, it's a general partnership. So there is a general partnership, is you guys coming together to work together towards the fulfillment of a certain goal that you guys have set for yourself. That is a general partnership. 2 or more, you agree to do business. It's an easy to form process. There are no legal requirements. You just go start the business and keep going. But what I tell people, and this is very important, I tell people that even when you form a general partnership, by default, it's going to imply that your incomes and expenses are shared equally among the members of the partnership, unless you have something called a partnership agreement. A partnership agreement becomes very important when you have a partnership. It is not required, but it is necessary. And that's very important because one of the biggest drawbacks of a partnership is that you have 2 different or 3, 4, 5 different people with different ideas. So at times internally there might be struggles to really make things happen because of the differences in opinions within running the business. So it might become harder to run a business when you have different people who all have interest in the business. Nobody has the single vision in running the business. So again, another thing is that the general partners are all liable for anything that happened. If somebody came to your business and fell and then sues the company, he is suing, he has access to all the general partners' assets. That is, so there's no limitation of liability. You have a few tax shields as well on there. You need to file separate tax returns. So separate tax return, what does that mean? So the company, when you have a partnership, by default, you have something, the tax filing is a 1065. The 1065 produces, so the 1065 is a separate tax return that is prepared for the company. But this is a pass-through entity, meaning it doesn't pay any federal or state income taxes. What it does is that whatever income that you guys distributed or you guys earned from that business, it's going to be allocated to each partner in something called a K1. That K1 is what you now take. Each partner takes the K1 and then goes and files their own personal income taxes with it. Again, one of the big drawbacks of this, just like the personal, is that you get exposed to increased self-employment taxes. We'll talk about that. The other one is a limited partnership. A limited partnership is someone here. In this case, it's a partnership that is, you are just investing in someone. There's a business that has been created. It's a legal, this one, it becomes more legal. There are some legal requirements around this. General and limited partners you have. So the general partner mainly runs the organization, and then the limited partner is that guy who is basically investing in the business. He's not running, he's not part of the day-to-day operations of the business, okay? And then he still gets a K1 as well. So, the main drawback of a limited partner is that you don't have any control. All decisions are taken by the general partners, and then again, you still have, there is still, it allows the company to be able to raise more capital than with the general partnership. Because when you have limited partners, you have access to getting other people to invest in the business, it helps you raise capital. Then there is one called the LLC. And I know this one is going to be one that many people basically talk about LLCs. Many people just believe, I've had many people come to me, okay, my business is an LLC. How do you know? They don't know. Because someone tells them that LLC is good. But LLC is one of the biggest advantages of that LLC is that LLC simply means limited liability company. It has legal protections. Legal protections means that as a company, it has limitation. Your assets, your person is different from the business. That's a big, big advantage. Which means that, when you start making money, like I say all the time, when you start making money, people are going to be looking to sue you so they can take money out, take advantage of you. When you have limitation of liability, then you can basically, if a person sues you, it's limited to the assets of the company. And that's why you hear so many of these people have been asking me, Donald Trump, why do people say he's been bankrupt whereas they say he's a billionaire? That is because the structure of the company, they have set up different LLCs for each activity that they're working with. That way, when the activity becomes exposed, only that section of that activity is affected. Your other personal assets or other businesses are not affected at all. And I say this because it's very important to the real estate business. It's very important in the trucking industry. It's very important to all those who have different segments of businesses. And this is an area where we can have a consultation. We can give you more. You call my office. We have people who can talk to you and give you more enlightenment on how you want to structure your company, especially when it comes to LLCs. With LLCs, you have the best of both worlds. What does that mean? It simply means that you have the benefits of that, all the benefits that accrue to an informal business, and you have limitation of liability on the and then you can also take tax benefits. You can take the benefits of a corporation. What does that mean? When you have, there is what you call a single member LLC, and there is what you call multi-member LLCs. A single member LLC is simply one that has a single member. You own it alone. You have registered. It's just like a sole proprietorship that has been registered with the Secretary of State's office. One of the key things about LLCs is that you have to register them. Okay? You have to register them. Once you've registered an LLC, then now you can either have a single member, and a single member LLC, for tax purposes, it defaults to a sole proprietorship. Because one of these things, remember, get this, the IRS doesn't know anything about LLCs. They don't care about that name. That name doesn't mean anything to the IRS. For the IRS, when you have an LLC, it either defaults to its sole proprietorship if you're a single member, or it defaults to a partnership if you're a multi-member LLC. So one of the big advantages you have with the LLC is that you can actually elect to either file as a corporation or to file as any of those as an informal business. So when you can elect to be an S corp, you can elect to be a corporation, basically. Membership, it's a membership organization, single member with multi-members. You have ability to elect. Some formality is needed. As I said before, you have to register, and then again, like I said before, the LLC doesn't mean a thing to the IRS. No election means default to social. You can default. I told you that already, that you default to either sole proprietorship or you default to a partnership. So this is the preliminaries of an LLC. Those are the basics of an LLC. There are so many things we can talk about that, and we can basically have consultations depending on where you are. Other formal business structures, you have corporations. And corporations, there are two main types of corporations. You have something that you call a C corp and an S corp. A C corp is a formal business, and it's a separate legal entity from its owners. A C corp is a separate legal entity from its owners. What happens with C corps is that when you it has the ability to raise capital through issuance of shares. You can issue different types of shares with a C corp. So you have that ability. You can easily raise capital. When you have, for those who have larger businesses, they are in the businesses that need high capital investment. Those companies that need higher investment. C Corp is a better route because it allows you to easily, you can more easily access capital than with other structures. The other thing is that it gives you a lower tax rate. So you file separate taxes for the company than you would for than for yourself. So a C Corp is a separate legal entity. And as long as you've not received any dividend or anything from that C Corp, you are basically filing your taxes without, there is no implication of the C Corp on you. As a shareholder, as an owner, if you receive salary, okay, you get a W-2 from that company and you file it for your taxes, for your personal taxes. If you receive, on the other hand, if you receive what you call, if you receive a dividend from that company, what happens with the dividend is that you are going to basically pay taxes. It is called, this is a capital, this is a return of capital. A return of capital is a capital gain. Whatever it is, you're going to pay taxes on it. And that is one of the major drawbacks of a corporation, of a C Corp, is that you get to file, you get double taxation. That company already paid taxes at a flat rate of 21%. But you still get to file to pay taxes on whatever the company pays you as a result of your investment in that company as a shareholder. Double taxation, many circumstances when a C Corp, there are thousands of circumstances. Remember, when we started this, I told you one thing. How you determine, how you structure your business depends on the strategic intent, the type of the company, what you want to get, your goals, your vision, all those things. They will determine how you structure that company. So basically, there are many circumstances where you would prefer a C Corp just because of some of the advantages we talked about here. And again, this is an area where consultation may be needed. One of the big things as well with C Corps is that you get to write off so many more things than you would with the other companies. For example, donations to charity is something that has a lot of there are so many rules around them. But if you are a C Corp, you can easily write off all the donations that you give to charity. You can raise capital through issuance of stocks. So there are so many advantages that you get from here. The cons of C Corps. Number one, more administration. When you have a C Corp, you have to file taxes, you have to do payroll compliance, you have to have board of directors, you have to have minutes of board of directors, you have to file taxes with the state, with the city. There are so many compliance requirements that are required from a C Corp than they would any other institute, any other type of business. Increased administration requirements, and then you get all those things. So we talked about that. Now, having talked about a C Corp, which is a much larger organization, has different types of shareholdings that are being issued. Let's talk about an S Corp. What is an S Corp? So generally, an S Corp is very flexible structure. It is a very flexible structure. Some people look at it as a business entity on its own, or some people look at it as a tax election. Regardless of how you look at it, it is, like we said before, we said one of the benefits that you get as an S Corp, it's a kind of a blended corporation. So you get benefits of a small corporation, but you also get the same benefits that you would with a larger corporation as a C Corp. So you can issue stocks. Even raising capital is easier, even though it has with an S Corp, you're limited to only issuing what you call how do you call it? You can raise what you call you don't have access to preferred stock. You have access only to the general common stocks. Again, with S Corp, it's a pass-through entity. An S Corp does not file, it files a separate set of taxes. They call it 1120S. So if you see 1120S as a set of taxes, we're talking about an S corp. If you're talking about a C corp, it's 1120 without an S. S simply means subchapter S, which is a smaller company. So 1120S is what you file for an S corp. And what happens with that S corp when with that is that you don't with an 1120S, there is no tax. It is not a taxable entity. It is just a pass-through entity. What you do, you also get a K1 from that entity depending on your interest in that company, and then you use that K1 on your personal income taxes. Okay, so there is no double taxation as when we talk about a C corp, because you pay the taxes on the C corp and then you still get to pay taxes on any distribution. Here you only pay taxes on your earnings, on your own share of capital of earnings within the company. With S corp, there's a limitation on the number of stocks you can issue, and then you can only issue common stocks. We talked about that. So having said all of this, how do you choose a company? I mean, there are so many things that we use to help you structure your company. It starts with you telling the vision. It starts with you clearly stating what the vision of your company is. Once you clearly understand what the vision is and where you want to go with the business, then we can choose depending on where you are. I mean, there are people who come to me, they're starting a business, they're a consultant, they're doing something. I just tell them, go make the money. Because once you start making the money, that's when I start seeing how can we restructure the company. Remember, in the US, if you want to, apart from being in particular industries, particular sectors of activity where you really need to comply with certain state requirements or certain industry requirements, it is basically the first thing is about just it is basically about going out there and making the business, make the money, and then we'll look about the taxes. We'll look at the taxes. So basically, what I tell people, if you want a quick start business, if you are a startup business, if your business is that type of business that is not complicated to start, if your business, if you're not concerned about having personal liabilities, because I mean, if I don't have a lot of money in my bank account, I'm not really worried, or I don't have a lot of assets, I'm just starting my business, I'm still trying to get my head around. I mean, I would tell you, you could start with a sole proprietorship. It's an easy startup. You don't have so many requirements, and then taxation is not an issue yet. Then you can start with a sole proprietorship. But when you start making a certain amount of money, I tell you, please, we have to restructure your business, because you have time to restructure. You have time. You have a certain amount of time. You either register as an LLC and then you restructure. You elect to be an S corp or whatever election you want to take. So in the case where you are already making money, once you start making money, you have concerns about being sued because you have your assets. You don't want to lose them. And then you have concerns about double taxation. If you have concerns about double taxation, you have concerns about you're trying to raise capital because your business is capital intensive, I'll tell you can either choose an LLC or you can choose an S corp. And this is only based on some of the advantages already outlined in the upper section. Then a C corp is really for the large guys. You have a big company, you want to open a bank, you were starting a bank, or you're starting a insurance company. Those type of companies that really need structure, and where the sector itself is there are so many compliance requirements to start the sector, and you are looking to issue stocks, you want to raise capital through different sources, then you will start with the C corp. And in taxation for a C corp, remember there are two ways of looking at it. If you are somebody who is going to defer most of your earnings in the earlier years of the business, then you don't really have issues of double taxation. Double taxation only comes in when you start distributing your dividends. And again, those are things that we can talk about. So C corp, all these different structures of companies depends on this. Remember, and I'm going to be very, very clear here. This appears to be, it's a very, very complicated structure. It is very complicated to really structure your company. Because if you structure it wrongly in the beginning, then you get into a place where you can't really grow your business. You're stifled because you did it wrong. Strategic intent is key. Speak to someone who has the ability, who understands these things, who understands the implication of each of these different structures from a tax perspective, from a limitation of liability perspective, from an administration's perspective, and even from a strategic intent perspective. That person is going to help you get there. So that is very important. So having said this, I think we've covered just a summary of some of the things that relate to structures of company. We've talked about the main structures out there. There could be a lot of things that could be added to what we've talked about. This is just for you to get a preliminary understanding of the process. I have a few questions coming through, and one of the questions I had was, where do I register my business? So this guy, he says, I have a business in Wyoming. So let me read the question. So where do I register my business? Do I register my business in the state where I operate, or in the state where I sell, where I sell my things? Okay, that's a good question. The first thing is, you always have to register your business in the state in which you reside. The state in which you reside is your original state where you register your business. The second thing, and this is very important, if you have a business and then you are, say, you have a sales point. You're registered in Texas, but you're doing a lot. You have a sales outlet in Virginia. Then it is possible that you may want to get a DBA in Virginia, where you are able to operate your business out of Virginia. You don't necessarily need to go and register that business there, but you want to open it, you want to get a DBA, or you can register the company there. But the key place where you register your business is where you are operating, where you are located. So if you have operations in different states, the least requirement is to have a DBA, so that somebody doesn't use the name of your business. Okay, someone is asking me, what are the advantages of S Corp versus C Corp? I think we've talked about that extensively. We've talked about limitation of liability. Both entities have limitation of liability. So you benefit from limitation of liability in the sense that the company itself is separate from you. So for when there is, for example, when there is if the debts of the company, if you are unable to meet your liabilities, to meet your obligations, only the assets of that company will be exposed to any litigation, not your personal self. Your personal assets are completely different from that company. Then with C Corp, we talked about the 21% flat rate. Well, that was with the current tax code is 21% flat rate. One of the things that you may get with them is that the S Corp give you the best of both worlds. With an S Corp, you can basically decide, even though you're filing taxes for the company, it's just a pass-through entity. It allows you to take a K1, which is your own share of ownership and incomes and expenditures in that business. You take your own share through a K1, a form called K1, and then you use that to file your 1040. You use that to file your personal taxes. One of the big advantages of an S Corp, which I didn't say, was that you are able, because one of the requirements is that the owner of that business is also, you get an employee, you get employed, you are on W2 in that when you have an S Corp. When you are on W2, you can basically pay yourself a reasonable income, and then all the remaining part of your income, of your earnings from that S Corp, are devoid of what you call self-employment tax, which is 15.3%. That's a big tax optimization tool right there. And I do that for most of my companies, because many a times you see companies that started as sole proprietorships, LLCs, they've been here for years, and nobody even tells you about how you can avoid taxes just avoid paying FICA, Medicare for the amounts that you're doing. So that's a big tax optimization tool right there. Another question that comes in, does an LLC save in taxes? An LLC by itself, if you ask me, does it save in taxes just having an LLC? No. An LLC is just a legal structure. It doesn't mean a thing to the IRS. An LLC gives you access to an election where you can elect to either be a C Corp or an S Corp. You can make that election through, there's a form that you file with the IRS to take that election. And you have it is time bound. You have a limited amount of time to make that thing happen. If you don't do it after that time, before that time, then you can still do it, but you have to have a reason why you did not make that election when it was due. So once an LLC saving taxes by itself, the answer is no. However, with different elections, you are able to determine how you want to pay taxes, which is a big benefit of an LLC. Another question that comes in is, how do I write off educational expenses with an LLC? So, the first thing is, what are educational expenses? Educational expenses, there are two types of that you really want to know. There's what the IRS calls qualified educational expenses. For a child or a person, for the first 4 years of college, you have what you call the American Opportunity Tax Credit. It gives you a certain amount of credit up to a certain number. I think it's 3,000 for 2021. So there is that, and that credit is for tuition and books and equipment. It is not for room and board. It's not for anything. Generally, when you are going through a qualified school, that school issues what they call a 1098-T. And you use that for your personal income taxes. That is the first part of what you call educational expenses. So you have American Opportunity Tax Credit, and then you have something called Lifetime Learning Credit. Lifetime Learning Credit, you can have it all over, for all, like as it says, lifetime. As for any education system, from any year. You remember the first one we said it was for the first 4 years of education. So until you get your bachelor's, after that you don't have access to it no more. But a lifetime is for any level of education. Then there is something called, so with that, we're talking about your personal income taxes. But if you own a business, and that business, for example, sends people to go and train. If people were to go and train as you own a business, those training costs, education costs are deductible. The IRS has a rule for determining what is deductible for taxes. It tells you that if you are going to enhance yourself for your current role, for your current position, then it is deductible. For example, if I have CPEs that I have to take as a CPA, those CPE costs are deductible. But if I were to go and start a new process of becoming an IT guru, that is not deductible. That doesn't help. So as long as it is to maintain or improve your skills at the current job so that you become more productive at the current job, it is deductible. So those are the two main things. So that is, I don't know if that answers your question, but it's not because it's an LLC. It just depends. It's just because when you are an individual, you get all this American Opportunity Tax Credit, you get all the lifetime learning credit. But when and then if you did certain things you own a business, you went and enhanced your knowledge in that business in order to be highly productive, then that is deductible. But if you were learning a different business, if you were trying to get into a completely different business, that is not deductible. Hopefully that understands. Any additional questions coming in? Those are the main questions I've seen so far. Lisa, do you have any other questions? So, yes. So basically, we are almost in time. I think we are meeting our time. It is 11. It is past our time. I just want to thank you for taking the time to be with us today and for attending this course, because I believe that what we talked about is so important for you guys building your businesses. I just want to tell you one thing. We are we are having a master class, a conference, a master class. We have this master class, which is on September the 16th. It is going to be great. It is going to be excellent. We're sending, the brochures are going out, and I want as many people to register. We're going to have it in two folds. There's going to be one that is in person here in Houston, Texas, and then other people can also join in online. So it's going to be online, and it's going to be live. It's going to be live online and in person. Again, this is a very important masterclass. We've taken a lot of time to prepare it, and all what is there is what we know are coming. Those are the things that we have seen through our years. Those are the things that people have asked us. We're going to be teaching them and helping you how to optimize yourself as you run your business. Again, I want to thank you for being here today. I appreciate you guys. I hope you guys have learned out of what we just said. Go and take your time. Listen to the video again. Listen to it 1 or 2 times. And then you are going to, I'm sure you're going to learn something that you didn't know at all. Thank you so much. You can call us. Call us at any time. Call us for free consultations. We are here to help you with these things. And call us if you want to join if you want to be part of that masterclass, which is coming soon. It's in 1 month. It's on the 16th of September, and I hope we are going to have a live, a full class, both in person and through the web. Thank you. You have a blessed day. Bye bye.